$79. That is the number. It's not a random guess, and it's not just a hopeful target for gold bugs. $79 an ounce for silver is the mathematical flashpoint that changes everything. But here's the part that nobody on CNBC or Bloomberg is telling you. If silver actually hits that price target, it doesn't just mean you make money on precious metals. It likely means the rest of your portfolio, specifically those high-flying tech stocks you've been holding onto, is about to incinerate. We are standing on the edge of a historic capital rotation. Most people look at the stock market and the commodities market as two separate worlds. They think Nvidia can go to the moon while silver stays flat, or that silver can have a bull run without disturbing the S&P 500. They are wrong. History shows us that when real assets like silver undergo a violent repricing, that liquidity has to come from somewhere. And right now, the most liquid, over-leveraged asset class on the planet is the technology sector. But there is a second, darker layer to this story. There is a reason silver hasn't hit this number yet. It's not just supply and demand. It is what I call the government limit. There is a ceiling that the powers that be, the Federal Reserve, the regulators, the big banks, cannot afford to let silver break. Because if it breaks, it exposes the devaluation of the dollar in a way that can't be hidden. Today, we are going to walk through exactly why $79 is the target. We are going to look at the mechanism that forces tech stocks to crash when commodities spike. And most importantly, we are going to discuss the government limit, the specific actions the regulators will take to try and stop this, and what you need to do before the rules of the game are changed overnight. Let's look at the board as it stands right now. You have the S&P 500 and the Nasdaq pushing all-time highs, driven almost entirely by a handful of mega-cap tech companies. The narrative is AI. The narrative is endless growth. The narrative is that the dollar is strong and inflation is under control. This is the illusion. Beneath the surface, the physical market for silver is screaming a different reality. We are seeing supply deficits that we haven't seen in decades. Industrial demand, specifically from solar panels, EVs, and electronics, is eating up supply faster than mines can pull it out of the ground. The deeper fundamental data suggests that the natural price of silver should already be well above $50. So why isn't it? Why is it lagging? Because the paper market is suppressing the physical reality. But this suppression works like a coiled spring. The longer you hold a beach ball underwater, the more violent the pop is when you finally lose your grip. We are approaching the moment where the grip slips. When that beach ball pops, it doesn't just float up gently. It rockets. And when financial assets reprice that quickly, it causes a shockwave. This is where the danger lies for the average investor. You are being lulled into a false sense of security by the stock market, while the real alarm bells are ringing in the metals market. You need to understand that these markets are connected by a single thing: liquidity. And liquidity is about to dry up in the one place you think is safe. To understand what is about to happen, we have to look back at the last time we saw a setup this extreme. We have to talk about 1980 and the Hunt brothers. This is the most critical history lesson for any silver investor, and yet most people learn the wrong lesson from it. The common story is that the Hunt brothers tried to corner the silver market, they got greedy, and the price collapsed. That is the sanitized version. The real story is that the Hunt brothers were winning. They recognized the inflation of the 1970s was destroying the dollar, so they bought physical silver. They bought so much that the price went from around $6 to nearly $50. They were right. The market was validating their thesis. The shorts, the big banks and institutions betting against silver, were getting crushed. They were facing bankruptcy. So what happened? Did the free market sort it out? No. The government limit kicked in. The regulators, seeing that the banks were about to fail because of the rising silver price, stepped in and changed the rules in the middle of the game. The COMEX changed the trading rules to liquidation only. That meant you could only sell silver, you could not buy it. Think about that for a second. Imagine playing a game of poker and suddenly the house says, okay, from this hand forward, you are only allowed to fold. You cannot bet, you cannot call. What happens to the price of the pot? It collapses. They forced the price down artificially to save the establishment. Why am I telling you this? Because if silver makes a run for $79 today, do you think the response will be any different? Do you think they will just let the bullion banks fail? Or will they change the rules again? This is the risk you are facing. You aren't just trading against market forces. You are trading against a referee who can rewrite the rulebook when they are losing. Now let's connect this to your Apple, your Microsoft, your Nvidia stock. How does a silver spike cause a tech crash? It comes down to margin. The global financial system is leveraged to the hilt. Major institutions, hedge funds, and banks often play both sides. They might be long tech stocks and short commodities, or they use their tech stocks as collateral to borrow money for other trades. When silver starts to spike toward $50, $60, and eventually $79, the entities that are short silver, or the entities that are on the wrong side of the inflation trade, get a margin call. Their brokers call them up and say, "You are losing billions on this silver position. You need to deposit cash right now or we liquidate you." Where do they get the cash? They don't have billions sitting in a checking account. They have to sell their most liquid, profitable assets to cover the hole. And what is the most liquid, profitable asset right now? Big tech. They will sell Nvidia. They will sell Amazon. They will sell Google. Not because they hate those companies, but because they have to. They have to sell what they can, not what they want. This creates a cascade effect. As tech stocks drop due to this forced selling, other algorithms trigger sell orders on the tech sector. Suddenly, the Nasdaq is down 3%, then 5%, then 10%. This is the inverse correlation. In a liquidity crisis caused by a commodity squeeze, the stock market becomes the ATM that gets rated to pay the bills. If silver goes to $79, it represents a massive transfer of wealth from paper assets to hard assets. That money has to leave the stock market to enter the metals market. It is a zero-sum game in the short term. You cannot have a mania in silver without seeing blood in the streets of the equity markets. This brings us back to the core problem, the government limit. We established that in 1980 they changed the rules. What will they do this time? The government and the Federal Reserve have a vested interest in keeping the price of gold and silver relatively stable. A skyrocketing silver price is a report card that says, the dollar is failing. It signals loss of confidence in the sovereign currency. If silver hits $79, it likely means inflation is running hot again, or there is a geopolitical crisis driving fear. If the price moves too fast, we can expect intervention. This could come in many forms. It could be raising margin requirements on silver futures, making it too expensive for traders to hold positions. It could be a windfall profit tax on precious metals. It could be open rhetoric from the Fed downplaying the move as speculative. However, there is a difference between 1980 and today. In 1980, the US debt was manageable. Today, we are over $35 trillion in debt. The Fed is trapped. They cannot raise interest rates to 20% like Paul Volcker did to kill the silver rally. If they do that today, the US government goes bankrupt on its interest payments. This suggests that their ability to enforce the government limit is weaker than it was in the past. They might try to stop it, but they might fail. Or they might sacrifice the dollar to save the bond market. This uncertainty is exactly why the move to $79 could be even more explosive than we think. If the market realizes the Fed is powerless to stop it, the psychology shifts from buy the dip to get me out of paper money at any cost. So, what do you do with this information? The prediction of $79 silver is not just a number, it is a warning siren for your portfolio. First, you need to look at your exposure to the general stock market. If you are 100% in equities, specifically weighted towards growth and tech, you are standing on the tracks and the train is coming. You are betting that the liquidity pump will never end. History says it always ends. I'm not telling you to sell everything and live in a bunker. I'm telling you to rebalance. If silver is truly undervalued and tech is historically overvalued, the smart money moves from the overvalued asset to the undervalued one before the crisis hits. Second, understand how you own your silver. If you own it through ETFs or paper contracts, you are exposed to the same counterparty risk we discussed with the Hunt brothers. If the rules change, paper silver is just paper. Physical possession or allocated storage where you have the legal title is the only way to bypass the government limit. They can change the rules of the COMEX, but they cannot easily change the fact that you hold the metal in your hand. Third, watch the ratio. The gold to silver ratio is currently sitting at historic highs. It takes roughly 80 to 90 ounces of silver to buy 1 ounce of gold. Historically, that number reverts to a mean of around 40 or even lower. When silver moves, it moves like a sports car compared to gold's minivan. It is volatile, yes, but the upside potential to reach that $79 target is mathematically far greater than gold doubling from here. We are entering a period where the old correlations are breaking down. The 60-40 portfolio of stocks and bonds is dangerous. The belief that tech always goes up is a trap. The $79 target for silver is more than just a price prediction. It is a symptom of a breaking system. It represents the moment when the market finally calls the bluff of the central banks. When that happens, the liquidity that has been propping up the stock market will vanish, and it will flood into the only assets that have no counterparty risk. The government will try to stop it. They will try to impose limits. They may try to change the rules, but the mathematics of debt and supply are inescapable. The beach ball is coming to the surface. The question is, when it pops, will you be holding the assets that are deflating, or the ones that are finally finding their true value? Don't wait for the news to tell you silver has hit $50. By then, the rotation will be over and the opportunity will be gone. Look at the charts, look at the debt, and look at history. The signs are there. Prepare accordingly.